Okay. So, good morning, good afternoon, good evening from wherever you've joined from any corner of the world. So, yes, respected dignitaries, eminent speakers, dear professional colleagues, and all the participants. On behalf of the Institute of Chartered Accountants of India, I, CA Pranav Mantri, warmly welcome you all to the 33rd webinar of Global Udan, organized by Development of International Trade Services and WTO Directorate ICI. Global Udan is not just a webinar series, it is ICI's vision to prepare the Indian chartered accountants for global opportunities, for global thinking, and the global leadership. In today's interconnected world, finance has evolved way beyond just the number crunching. It now involves strategic decision making, cross border transactions, global regulations, risk assessment, value creation, and the list goes on. So that is why today's theme, global finance, from deals to decisions, it is extremely relevant for professionals working in APO, global consulting, M&A, international taxation, valuation, and finance leadership roles. This webinar is organized by Development of International Trade Services and WTO Directorate, ICAI, which continuously works towards empowering members with global exposure, international trade insights, and overseas professional opportunities. Our convener, CA Sanjeev Kumar Singhal sir, and our our convener, CA Abhay Chachir sir, and our deputy convener, CA Sanjeev Kumar Singhal sir, has definitely been a pivotal role in leadership and strategic vision, which is continuing to strengthen ICI's global presence. And definitely, this committee is coming up with a lot of important certifications and sessions right from Australian accounting standards, US accounting standards, which is really a fruitful and important thing for all the aspiring as well as the qualified chartered accountants who want to grow in the global arena. Now, it's indeed a pleasure for me to introduce our today's wonderful speaker, CA Bandana Kaur Bhatia ma'am. Yes, she's currently working with one of the big fours and is passionate about breaking down complex finance concepts and connecting theory with practical business realities. Having a rich exposure to cross border transactions, financial strategy, and professional judgment, and deep understanding of how global deals translate into board level decisions. Her exposure at the Big Four has allowed her to see how theory meets reality in large organizations, startups, and fast growing businesses. Alongside her corporate journey, she has also been actively involved in career guidance sessions for students. I believe we same the same passion there, and helping them make informed decisions about careers in finance, auditing, and account. She brings a perfect blend of technical excellence and strategic insight, which makes today's session extremely valuable for all of us. So, really, we are eager to learn from your experience. Over to you. Thank you so much for joining us with your valuable time.
Thank you and good afternoon, all. And thank you for such a wonderful introduction. So, before starting, I'll just share my slide. I hope the slide is visible.
Yes, it is.
Yeah. So, okay. So, today's topic, global finance from deals to decisions. So, today, as chartered accountants, our role goes beyond auditing and accounting, and that is exactly what we'll be discussing today. So, before we deep dive into the concepts, we should understand what finance and why finance is important in today's world. So, every major decision, whether the company will be expanding globally or a startup raising funds, government framing the policies, and even an individual planning the wealth, all these transactions are involved in are driven by finance. And finance is no longer just about numbers and accounting, it's about decision making. And hence, today's topic is global finance, which is from deals to decision making. And we will see who are the players who are involved in the process. So, the global finance is a part of, like, it's a big ecosystem where we have a number of players working into it. So, finance is all about decision making, And those who understand finance, they don't just understand that finance is all about recording the transactions, but our decisions actually shape the outcomes. So we as chartered accountants, we should actually understand what are the opportunities we have in the field of finance. So we have accounting and auditing opportunities, which we usually have them, but in today's world, even in finance, we have a number of opportunities. So today, a chartered accountant can move from compliance mindset to business and finance decision making mindset. Okay, so uh, today we'll move to the entire like global finance ecosystem. Like we'll see how. Just a minute. Okay. So today's our agenda is. Just a minute. Give me a minute.
Your voice is low.
Is it okay now?
Yeah,
Yeah.
perfect.
Yeah. So I'll once again share my screen. Visible now?
Yes.
Okay. Can I just know which screen is visible now?
No, you go to the PowerPoint screen now.
Sorry.
You go to the PowerPoint screen. Yeah, perfect. Now you can continue from here. Yeah.
Fine now, right?
Yes,
Can I have a minute, please?
sure thing. Viewers, just allow us 2 minutes. We'll be starting. Yep. Okay. Yeah, it's visible, the interaction.
I did not get the mail. Just a minute. Pranav, is it possible for you to share the screen?
For me,
Yeah.
I can share the screen, but I don't have the PowerPoint with me.
Ma'am, PPT is with you, so you have to share the screen.
Exactly.
I'm sharing only the PPT, but my full screen is visible. So
You can give the brief while showing the PPT. Na? If you want your reference, you can take in your mobile.
yeah. So the file is huge. I'm not just not. Okay. So we are perfectly ready now, and extremely sorry for this. Yeah, I hope it's good.
Yes, it is.
Perfect. Okay. So we were yeah. So we were into global finance. So let's start with the introduction first. Okay. Uh, So, global finance is not just about money, it's about decisions we make under uncertainty. So, every merger, investment, trade, valuation, and a choice, like everything which involves a choice, where the capital should go, how the risk, how, like what is the risk, what is the return, all these things requires decisions to be made. Now, why you think that decision are important. For example, if your budget is rupees 1,000 and you have four alternatives in front of you, like which company or in which fund you have to invest. What now if your budget is 1,000 and you have to choose among which fund to invest, you have to see whether what is your investment and what is your return. For example, if a company generates return of around 1,200, which is more than the other companies, you will choose that fund because your capital is limited. If you have unlimited capital, you can invest in all the companies. There's no need of taking any decision in which company to invest. So since your capital is limited, the choice comes under picture. So uh, here, global finance, it refers to management of money, investments, financial risk across borders, institution and markets, and it connects the capital providers and capital seekers. The capital providers are the investors who invest in the company, and the capital seekers could be anyone. It could be corporations, it could be government, it could be entrepreneurs, and anyone. And this enables the execution of deals, and these deals ultimately turn into strategic business decisions, right? Okay. So, today we will be covering the four pillars of modern finance, which are investment banking, private equity, hedge funds, and all these uses financial modeling. Financial modeling is not a separate, like it's a tool which is used by all of them, like investment bankers, private equity funds, hedge funds, all of them uses financial modeling tools to evaluate their decisions. So financial modeling is a tool, whereas investment banking, these are the separate firms who take the decisions about the company and about the investment. Okay, so the four pillars of modern finance are investment banking, financial modeling, private equity, and hedge funds. Now in the coming slides we'll discuss each one of them in detail. So just to give you a overall clarity about what are these. So investment bankers are the one where the deals are created. And private equity are the one who actually invest, who where the ownership, like private equity you actually invest. Private equity funds actually they are the funds. So the investor invests in these funds, and these funds in turn invest in private companies. And then hedge funds are just like we trade, we analyze, we trade, and then we generate returns for maybe short term purposes. So these are not actually individual concepts, these all are just interconnected with each other, and these are all the sequential stages of product finance life cycle. Okay. And okay, so before understanding all these concepts, we have to know like how are all these concepts linked. So just now we came to know that all of these concepts are not individual concepts, these are all product, these are all a part of a finance capital life cycle, right? So how are these four pillars linked to each other? So investment bankers are the advisors, they are the intermediaries. They help companies to raise the capital. They suppose if a company wants to acquire another company, these investment bankers comes into picture, and they suggest, they uh, help in cracking the deal. So these investment bankers are advisors, they are the intermediaries. They help the companies to raise the capital, they help in mergers and acquisitions, and they also help the companies who are going into IPOs for the first time, initial public offerings, right? And then we understood that investment bankers are the advisors. Now what is private equity firms? Private equity firms, they acquire controlling stake in private companies. So private companies are the ones which are not listed on the stock exchange, right? So these acquire the controlling stakes in private companies. They so why they acquire controlling stakes in private companies? And see, one more thing is that normally if we invest in shares of public limited companies, we don't have that control. We cannot operate, we cannot manage, we are not a part of the management of the company, right? But these private equity firms, they invest in private companies, they improve the operations, they participate in the management of the company, they participate in the board, and they improve the cash flows of the company. They also plan the capital structure of the company, and after the value addition, they see operate and they generate cash flows, like they improve in operational efficiency of the company. After that, when they see a right time, when they see there is a value appreciation, they exit from the company. Okay. And then we also have hedge funds. So just to give a clarity, investment banks are advisors, whereas private equity firms and hedge funds comes under alternative investment funds. So alternative investment funds are again, they have regulatory requirements by SEBI, they are regulated by SEBI. So under them we have this private equity funds and hedge funds. So we can see that alternative equity funds, alternative investment funds are the umbrella under which we have all the categories. So we will also see that alternative investment funds are of three categories: category 1, 2 and 3. Okay. So all these, that is the investment bank, private equity and hedge funds, they use financial modeling. So financial modeling, what is financial modeling? It is financial models you just prepare on the Excel. You give the input output, you just give the inputs to the Excel, that is the revenue, the units, all the numbers, and then you also give the return you expect, and then it generates your output. So based on your inputs, you get the outputs, and this helps the investment banks and this private equity hedge funds to actually generate decisions like how a company can generate revenue, what are the future possibilities for the company to grow. So financial modeling is a tool which helps which helps them to plan the decisions. Okay. Okay. So let us start with the investment banking. Okay, so investment banking is a specialized segment of banking that helps governments, corporations, and institutions to raise capital, buy or sell business, and make strategic decisions. Investment banking is a so investment bank is unlike commercial banks. In commercial banks, we accept the deposits and we lend the loans. But in investment bank, it is separate from commercial banking. How? Investment banking is a specialized segment of banking. So who are the who take the services of investment banks? They are governments, corporations, and institutions. And this investment bank help them to take decisions like where to invest, how to invest, what is the capital to be invested, what are the returns we can expect from that. This is the main function of the investment banks. They help in making the strategic decisions, strategic financial decisions. That's important. So finance, not they investment banks also involved in paperwork, but the main function is to take strategic financial decisions. So the key takeaways in investment banks could be in US in 1929 there was a huge crashes in the stock, in the stock market. At that time, what happened is the Glass-Steagall Act. There was an act named Glass-Steagall Act. It came into picture and it said that because of the huge crashes, the investment bank could not carry commercial banking services. That is, a company could not provide investment banking and commercial banking services at the same time, because see, in commercial banks, the retailers' money are involved. The individuals, the retailers, the money of the individuals are involved, right? So what this investment bank does, the this money which is in which are accepted by the commercial banks, they take that money and they invest in large risky proposals. What investment bank does? It invests in large risky proposals so that they can generate the return, because higher risk higher return. Investment bank takes risk, and that's the reason they could generate higher returns. But the government at that time, they don't want the individuals money to be at stake. So at that time they said that a company cannot carry investment banking and commercial banking services together. But again in 1999 this Glass-Steagall Act was separated, and it said that a single company can carry the this both the services together. So now we have many firms who are also doing the commercial banking services and also investment banking services. We in India itself, we have many firms. We have ICICI, we have HDFC, we have Axis. They are doing commercial banking services, that is providing, they are providing deposits and loan, and they also have the separate segment who is involved in investment banking. So investment bankers provide expert advice and management for large projects, because billions of dollars of rupees are involved in this projects. So they actually save clients time and money, because see, clients have limited exposure. They don't know, they have the money, they have the capital, but they don't know where to invest the money to generate the maximum returns, what are the risks involved, and how can they generate capital appreciation. Then the investment banking comes into picture, the bankers, the investment banking firms comes into picture. Okay. So the services provided by investment bank are capital raising services. That is, they help in IPO raising. They help at the time of IPO. So normally in the prospectus, we can see see the investment bankers' names also in the prospectus. So they provide services during that. They also provide advisory services for a company in mergers and acquisitions. If suppose a company is involved in acquiring another company, or a company wants to merge with another company, they take the services of investment banker. And investment bankers also provide additional services, that is valuation services, due diligence, deal structuring, and regulatory compliance. So investment bankers also provide regulatory compliance services, that is, they are involved in they also look after the paperwork, after the regulatory compliances which they have to file with the regulators. And who they serve, who are the various, like corporations, governments, all the four, like high net worth individuals. Normal individuals cannot take the services of investment bankers. Okay. So they just analyze, so investment bankers are for high net worth individuals. So corporations, government, and investors and high net worth individuals take the services of investment bankers. So these are just few examples where investment bankers have played a key role in investment banking. So daily we hear the news of companies merging, companies acquiring, and IPOs. We see a lot of news, right? In all those transactions, investment bankers are involved. They actually tell how the transactions are to be routed, how are they how will they perform the transactions, and what they also help in valuations, like what should be the valuations of the firm, whether it is correctly valued or not. So these are few of the examples where the first one would be Meta and Facebook and WhatsApp. So now you could see that so Meta Platforms Inc. is a company under which we have Facebook, WhatsApp, and Instagram. So these are the apps of the company. Previously, Facebook and WhatsApp was a separate company, but now Meta Performance Inc. owns these companies. Okay. Now, for example, if you can see, if you upload a photo on your Instagram, that also goes to your Facebook account because they are linked. You can also see that in WhatsApp you has the Meta AI feature, right? So all these companies are owned by Meta Inc. So who are the major banks? Like who are the major banks who are involved in investment banking? The major players who are involved. We have Goldman Sachs, we have JP Morgan Chase, Morgan Stanley, Bank of America, Citigroup, Barclays. All these are investment banking firms. They have the segment in investment banking, and they carry all the services. In Indian context, we have Kotak Investment Bank, we have HDFC Bank, we have ICICI Securities, and we also have JP Financial. So these are few of the examples who carry the investment banking services in India. So okay, so let's discuss the key valuation methods which are used by investment banks to value the company. Okay, so since financial metrics are involved, it's the valuation, the correct valuation of the company is a key metric used, right? If the valuation is right, everything flows right. Okay, so these are the different valuation methods. First, we have comparable company analysis. In comparable company analysis, we compare our company with a similar company in the same industry. For example, uh, if a company is into steel, it will compare it metrics with a company who is in steel industry, in the same industry. So it will take the, like, it will calculate it will take a multiple, and it will use its multiple to its financial statements, so that we can compare and generate the value of our own company. For example, if a company is in steel industry, for example, it will compare its financials with steel industries only, and then it will generate what should be the value of this company in accordance with the company is already performing well. So according to that, it will generate value of their own firm, their own company. Then we have precedent transaction analysis. Precedent transaction analysis is the company uses its financials, like how its own revenue, its own cost drivers, and generate what should be the value of its own firm. The most commonly used model is DCF analysis, discounted cash flow model. It's one of the most, and mostly in all the mergers and acquisition and all the East, this model is used, and it's one of the key model, we can say, in valuation. So what is discounted cash flow analysis? The company, it calculates all the cash flows of, it calculates the future cash flows, and it also calculates the terminal value, and then a present value factor is used to bring all the cash flows to the current value. And according to that, we will derive the valuation of the company in at present, in today's world, using the factor, using the cash flows, and using the terminal value. So this is the most commonly used valuation model. Then we have asset based valuation. We use the assets of the company, we minus the liabilities. It's similar to working capital. You take the assets, and based on that we derive the value of the company. Then market capitalization, enterprise value by EBITDA. We have price earnings ratios. Price earnings ratios are also used for huge companies, and also for small transactions. It's a commonly used practice. Then we have dividend discount model. Similar to cash flows, we, instead of cash flows, we use dividend to derive the value of the company in the current scenario, in today's in the present. Then we have leveraged buyout analysis and sum of parts valuation. Sum of parts valuation is used when a company is into diverse business. Like the company is also into cement, the company is also into steel, the company is into technology. It has diverse business units. For example, Reliance. It's almost in every sector. It's in every so what in the sum of parts valuation, we first take the value of the individual units, and then we see, as the name suggests, sum of parts. First we take the value of the parts, and then we take the sum of them to derive the value of the whole company itself, right? Okay, so now we have the concept of alternative investment funds. So as discussed, alternative investment fund is a big umbrella. Inside that we have private equity, hedge funds, and alternative investment funds are also divided into three categories. We have category 1, category 2, and category 3 funds. So alternative investment funds in India are privately pooled investment vehicles. They are regulated by SEBI. So the regulator of the alternative investment funds is SEBI. So they gather money from investors. They invest in non-traditional assets. Traditional assets are equity, debt, bonds, etc. Okay, non-traditional assets are the examples of non-traditional assets are private equity, venture capital, real estate, hedge funds. So as discussed, they are split into three categories, and each category has its own regulations, has its own rules, and also the taxation of the three categories are different. Okay, so the first category in alternative investment funds, they focus on startups and infrastructure. The second one focuses on private equity and debt. So we will discuss about private equity and venture capital in the coming slides. So they both come under category two alternative investment funds. Then we'll also discuss about hedge funds, which comes under category 3 of alternative investment funds. So category 3 uses actually complex strategies to derive, such as hedge funds and derivatives. They actually use complex models to generate the returns, and hence the taxation structure is also different, because in category 3 the tax is borne by hedge fund itself, because we have two concepts. One is the pass through concept, where if a fund generates a return, that return is passed on to the investors, and the investors pay tax on the returns generated by the fund. Whereas in category 3 hedge funds, in the here the hedge fund itself pays tax on the returns generated by it, and after paying the tax, whatever is the remaining return, it passes on to the investors, and hence the return of the investors is low. It because already tax has been paid on the return generated by the fund. Okay, so yeah, so just to link the concepts, I have introduced the alternative investment fund here. So alternative investment funds have these categories, that is private equity, venture, and hedge funds. Okay, so what is private equity? Private equity is an investment class where firms raise capital to acquire and manage private companies or take public companies private. So the main thing to remember in private equity is, it is a investment class where it is a fund which invests into private companies. It can also invest into public companies, but they take the public companies private, and then they invest in such companies. So, and why they invest? Because as already discussed, these companies participate in the management. Help in uh, they help in improving the cash flows of the company, and then they exit at a profit. Like when there's a value appreciation in the company, they exit by selling it into the profit. And one more key point, like one more key feature of private equity is they require significant capital commitments. It's not like short term, you just invest and you exit immediately. It's not like that. It's actually a very long term commitment. You have to invest in the company, and then you have to exit after a long period of time. You have very long capital commitment involved, right? So Okay, one more thing is it is a control oriented investment. So as discussed, they participate in the management and have control over the business. So private equity is a control oriented investment investing. And one more difference between private equity and venture capital. So venture capital, they normally invest in startups and the businesses who are in the early stages, in their early stages. So the difference between private equity and venture is they private equity involved in scalable, like a business who is already mature, who is already into the market, who have generated, who has seen the market, usually 5 to 6 years. Okay, whereas startups invest in, sorry, venture capital, they invest in startups. So this is a key difference between private equity and venture capitalist. Also to say that venture capital is one of the type of private equity. Venture capital is also private equity, but a kind of private. So private equity is again under the main thing, which contains again the various venture capitalists and others, which will be seen here. Okay, so on the screen there is just a visual representation of how a private equity works. So normally private equity are registered as a limited liability LLPs. Okay, uh, so we have a general partner, he's the one who just manages the fund. Then all these are generated into the fund, the investors invest into the fund, like it is a pool of assets creator. They take the money and then they invest into the private equity firms. Okay, and the fund which manages is known as the private equity fund. Okay. Okay, next, see, as already said, venture capital is a type of private equity. So we have various kinds of private equity as seen has shown on the screen. So first one is venture capital. As already discussed, venture capitals are the funds who normally invest in startup companies. And okay, venture capital fund is the most commonly used private equity kind. Okay, so venture capital is the most common type of private equity because we use these words interchangeably. We know venture capital, like they invest in startups, we have that definition in our mind, but we don't know that most of us would not know that this comes under private equity, and private equity has all these types. So it normally invest in early stages startups with high growth potential, and investors actually provide small amounts of capital in exchange of equity. And this business is actually very risky because we don't know what the business holds, what the future, how are the cash flows of the business, because it's the product which company sells would be new in the market. And if not new, the company is new in the market, and we don't know what would be the cash flows involved and how the company would perform in the future. For example, if you have already if we have a company which is mature enough, we have the historical data of that, we know what would be the cash flows involved in that in the company. We can analyze like how future is anyways uncertain, we don't know what future holds, but we can just predict based on our historical data. But in venture capital we also don't have that. We don't have the historical data of the company because they are new in the business. Okay, so these are generally risky in the risky in nature. And but if a startup is successful, it will derive massive returns. So it's like high risk high return low, it's like if a startup will derive returns, it will derive high returns, and if it's in loss, then all the capital is just gone. So it's high risk high return kind of thing. Okay, next, just to brief about it, venture capital is invest in startups. The investment size is usually small to moderate, and the risk level is high because of the uncertainty, and the return expectations would also be high because the risk is high. The investor is expecting high returns because the risk is high. If the capital is gone, whole capital is gone, right? So and he would be, whoever is the investor who will be investing in venture capital would obviously expect high returns. Okay, so next we have growth equity. Growth equity is another type of private equity. In growth equity, the focus is on already established companies seeking expansion. See, in growth equity, the company is already there and it wants to grow for expansion. It wants to grow. It wants to grow its business. It wants to go in diverse sectors, and it wants additional capital. It wants additional capital into the business so that it can grow, so that it can expand. Okay, so investors normally inject capital to help the business to scale its operations, expand their market reach, and also launch new products. Company can launch new products. Already if it's a selling product, it can scale its business, it can expand. So that's the reason, that's a kind of private equity where investors invest for a company to just scale in the business, to expand in the business. Okay, so the key points in growth equity are, the established companies. What is this? The established companies are seeking the investment, and the investment size is actually greater than venture capital. Venture capital is starting its business, right? It wants a capital so that it can see how it can expand, like how it can start its business, what are the opportunities available, for whether the product which the venture capital, the startup is bringing, whether is it scalable, whether the customers are willing to buy the product. But in growth equity, it's already established market here. It just wants to scale, to expand, and hence the investment is also big in growth capital as compared to venture capitals. Then the risk level is moderate, and the return expectations would also be steady, like depending on the risk. Then we have leveraged buyouts. So this is the most we normally hear this leveraged buyouts in many times. You have heard leveraged buyouts many times in we heard this in news. And so just let's understand what the leveraged buyouts is, and then let's discuss. Okay, so leveraged buyouts is investors secure a controlling position in an established business. So already the business is established. Here the owners, the investors, they want controlling position in the business. Growth equity, that's not growth equity. The objective of growth equity was for expansion, they need investment. In leveraged buyouts, the investor wants controlling position in the established business. So mature businesses normally target the leverage buyouts. Usually the cash flows in the leveraged buyout, in these companies are like equal, they are not that fluctuating. They are stable cash flows. And so the things to remember in leveraged buyouts are, the cash flows are stable, and the investors want a controlling stake in the business. And one more thing is, the investors, whoever invest in these companies, they usually invest in these companies through taking the debt. Okay, they invest in the company, but it's not their own money. They take the debt from the company to invest in the company. So the cash flows of the company in which they have invested, that is used to pay the debt. Okay, so this is a three-way cycle. So we have an investor who takes the debt from the banks or some, and then he invests in the company, and the company then generates the cash flows, and that cash flows are used to repay the debt. Okay, this is the you can say the definition of leverage buyouts, where the investor uses the debt, uses the cash flows of the company to repay the debt. So investor doesn't use his own money, he uses the debt to invest in the company. So normally, where is the focus on leveraged buyouts? It's on mature businesses who have stable cash flows. See, if the cash flows are unstable, if we don't know what the future holds, if the future cash flows are uncertain, then how will we repay the debt? Because debt is, we have to repay the debt, right? And in venture capital and this, since we don't know the future, we cannot take a debt, and we cannot rely on the cash flows of the company to repay our debt, because we don't know what how will the cash flows be in the future for the venture capital, the startups and all. In leverage buyouts, the cash flows in the company where the cash flows are stable, we know that this will generate a stable cash flow so that we can repay the debt. In that scenario, leverage buyouts are used. So it's a kind of private equity where debt is used to repay the, where cash flow is used to repay the debt. And you know, right, money makes money. So we take money from, we take the debt and we then invest, and whatever is the difference we just earn. So money makes money, it's the same concept. Okay, next, distressed investments. Distressed, as the name suggests, it's a kind of investment in a company which is running into losses, which has which have negative cash flows. To revive the business, we just push in some capital into the business, so that the company can perform, so that the company can go above its level, so that the company will generate the profits, start generating the profits. Okay, distressed investments, they target the businesses with financial difficulties. Investors purchase these companies below the market value. See, if the company is already running into losses, if we say that the market value of the company is this, you have to pay this, it will say just exit, just don't, because the company might um, liquidate. Okay, and that's the reason they are also willing to value their business, devalue the business, and the investors value the business, they devalue the business and then invest in the company. So normally investors purchase these companies below the market value. And why will they purchase? Because to enhance the business, to generate profitability, and to enhance the performance. Okay, investors might restore the profitability to debt restructuring. So there could be many reasons for losses. The company, because of the debt, maybe they have taken so much of the debt, because of that they might be incurring losses. It could also be because of the operational inefficiencies in the business, because of the processes, because of the procedures followed by the business, because of the operational inefficiencies, the company might be running into the losses. So they just these investors uh, come into the company, they invest into the company, and they check what is the reason for losses, and then they involve, and then they help to revive the business. Okay, so what's the focus? The focus is on investing in the companies who is struggling in the business and is having and is facing financial trouble. And the risk is high, because we don't know like how will it actually generate the cash flows, even after we investing in the business, we don't know, right? The reason could be anything, that the company is running into the losses, we can fix the reason, but what if that still the company is running into the losses, and that's the reason the risk is high. So we just see whether can we generate the profits, can we revive the business. Okay, but what if the business recovers? If the business recovers, we have substantial profits, we have, like, it's same as the this concept is same as that, because if the business revives, we'll have more profit, and if not, then it's just okay. So mezzanine financing. So the word is a kind of fancy, it might look fancy, mezzanine financing, but it is the concepts which we all know, which we all use. So mezzanine financing is a blend of debt and equity. Okay, just this, the word is fancy, but we all know the thing, that it is a that is a structuring, we use debt and equity to buy a company. So I hope I expect you to remember something from this mezzanine financing. uh, the show Shark Tank India. What does they do? The most of their valuation is like 12% debt and 2% equity. So what's this? This is an example of mezzanine financing. Okay, you could relate it to the to that show. In mezzanine financing, this is a blend. The investor blends equity and debt. It will give a part of capital in debt, and it will give it will invest a part in equity. Okay, so they structure the deal based on the valuations and all. They come into a conclusion how to invest. Now, why 12%, 2% equity? Are these numbers favorites of sharks? No, right? They actually analyze the business, and depending on the business, depending on the expectations, depending on the returns which the business generates, they come to the figure, and they just structure the debt and equity portion. So normally companies seeking funds for expansions, acquisitions, restructuring, they often use this method of mezzanine financing. And it has two portions. One is fixed interest payment, like the investors, whoever are investing, they will generate the fixed income through interest, and they will also generate returns to capital acquisition, since they have also invested in equity. So they will enjoy the returns with in two ways. One is through interest payments, which are fixed periodical payments, and then we also have equity, that is the capital appreciation whatever they derive, because since they have also invested in equity. Okay, so the risk could be moderate to high, because we have the fixed thing. We are receiving the fixed interest payments, right? So hence, if we are investing in equity, we can say that the risk is very high. But we are also investing in debt. That's the reason the risk could also be moderate, because it's sure that we will receive the fixed income. We will receive the interest thing. Okay, so hope the mezzanine financing is clear. It uses blends debts and equity. Next, we have fund of funds concepts, that is FOF. Fund of funds are the investments where the fund, we invest in a company, like we invest in a company, and investor invest in us, like it is a layer of thing. Someone is investing in one business, like A is investing in B and B is investing in C. So it is a concept of layers. Okay, so fund of funds make investments into several different private equity firms. Okay, uh, we also have for example, this strategy, actually fund of fund strategy, it also helps in diversifying the business. So for example, if I am the company, I am A, I will be investing in A, B, C, D, E. No, if suppose I'm investing in only one business, there is high risk. If the business collapses, all my investment is gone. Here I'll invest in different kinds of business. I will invest in different kinds of business. I will diversify my investments. I will diversify my portfolio by investing in different kinds of companies. So fund of funds makes investments into different kind of private equity funds. Okay, this strategy allocates investments through different sectors and geographical, also the sectors and geographical, like it depends on us in which, whether we have to invest in same sector, whether we have to invest in different geographical sectors, different markets, different. So it's just diversifying the investments. Okay, the risk, the returns are also lower, because we are diversifying our portfolio, right? Hence, since the risk is low because we are diversifying our portfolio, and hence the return is also low when compared to other private equity funds. Okay, then we have real estate private equity. The name studies that private equity, this private equity focuses on property investments, right? Okay, so property investment could be commercial buildings, infrastructure, residential complexes, property development projects, and they generate, like they get returns from property appreciation, rental income, and also through selling the property. So this is the way they generate the returns in real estate private equity uh, kind. Then what's the risk involved here? The risk depends on market conditions. If the market performs, if it performs well, the returns are high, and if the market performs, if the decreases, then our returns also goes down. Okay, so we have lot of private equity options. See, all these types we can invest. We have lot. We can invest in ventures, we can invest in already business who are in expansion, we can invest in real estate. We have so many options in private equity itself. And okay, I hope private equity is clear. Then the next kind of thing, so in alternative investment fund we have covered private equity. Then we have hedge funds. So in alternative, we have private. In private, we have venture capital is a kind of private equity. In private, then and in alternative, again, we have hedge funds. So this is like a flow chart, a flow diagram. Okay. So hedge funds are regulated by SEBI, Securities and Exchange Board of India. And let's understand first the definition of hedge funds. So these are the funds. These are normally unregistered private investment partnership. Normally private equity and the hedge funds are registered as LLP. So again, hedge funds are also generally, this is a generally they are registered as private investment partnership. Again, what they do, they pool the resources from the investors and they invest in the market. This is unlike the traditional thing. Now you might get a doubt that what's the difference between mutual fund and private hedge funds, because mutual funds also does the same. It pools the resources from the from the individuals, and it invests in shares, the equity, and bonds. So what's the difference between hedge funds and mutual funds? So normally hedge funds are traded by high net worth individuals. High like the minimum investment required is 1 crore rupees in hedge funds. So this option is not available to us. So uh, the hedge funds and mutual funds are same, but you can understand that hedge funds are for high net worth individuals and mutual fund are for us. Like even a person having 500 rupees in his pocket could invest in mutual funds, but that's not the case in hedge funds. They require huge investments. Okay. One more thing is the hedge funds actually they have many options to invest. They can invest not only in equity and bonds, they can invest, they have many options to invest. Hedge funds in India do not necessarily have to registered under SEBI. Hedge funds are regulated by SEBI, but registration is not important to them, whereas mutual funds have so many regulatory requirements that they are it's necessary for them to register under Securities and Exchange Board of India. Mutual funds also have to derive the NAV, like daily they have to calculate the NAV and report it to the investors. Like the data is available in public, okay, but hedge funds, they don't have such regulatory requirements. So what they do, they pool the money from large investors like high net worth individuals, banks, pension funds, commercial funds, and they invest in the securities, they invest in the markets. And again, as discussed, they fall under the category of alternative investment funds. And the pool money can also be used to buy the securities like outside the country, like national and international. It can be used for the both. So the long list of securities, equity, bonds, real estate, currencies, securities, derivatives, there is a long list. Like hedge funds are having many options to invest, but mutual funds, they have to play safe because the individual's money is at stake. And that's the reason even the regulatory compliance is very strong for them. Whereas hedge funds, they don't have such regulatory requirements because private players, high net worth individuals, they actually invest so that they can take risk and generate higher returns, right? But in mutual funds, it's not the case. We invest in mutual funds because we have our own purpose. We actually invest to play safe. Okay. Next, some of the characteristics of hedge funds. Okay, as discussed, we can say the characteristics just looking at the definition of the hedge funds. What are hedge funds? They are investment partnerships, and what they do, they strategize like how can we generate maximum return. They create strategies, and then they take the position in the market depending on the expectations. And they use the trading techniques, instruments, and then we also have that financial modeling we'll discuss in the slide. They also use that. So this private equity, the investment, they all use that financial modeling tools and various tools to calculate the returns generating based on the inputs we provide. And usually high net worth individual, that is in India, it's 1 crore rupees. Like high net worth individuals usually invest in such kind of hedge funds. Okay. Next, we have different hedge fund strategies. It can the hedge fund, they can use different strategies based on their risk appetite and the return they are expecting. We have long and short equity. We have global macro. We have event driven and quantitative. Let's discuss them. Okay, so long and short, taking into consideration long and short positions, they aim for returns based on the individual companies' performance. So we have the similar kind of thing in we take the positions in the market based on the return we expect. We based on the company's performance we derive the returns. Okay, then we have global macro. This strategy invests in various assets influenced by global events like changes in interest rate or currency exchange rates. So based on the global events occurring in the market, these hedge funds generate profit. Okay, so they take positions depending on the economic trends and events going on in the market. For example, if there is a currency rate fluctuation, if the currency exchange rate have increase, based on that they will strategize and invest in the funds. Then we have event driven is a individual company experiencing significant corporate events. Like for example, if a company is going into merger, it's going into acquisition and it's liquidating, that it's bankruptcy, based on that they strategize, and based on the events they invest in the companies, invest in the shares of the companies. Next we have quantitative. So quantitative is, again, we just use the models and algorithms to identify where could we invest, what are the opportunities we have, what are the open opportunities. Based on that we use based on that we just invest. Like these are quantitative. Again, financial modeling comes into picture. We use the models and everything to identify what is the best strategy to be used by us. Okay, so again, we have hedge funds are classified into three. This is offshore, domestic, and fund of funds. Okay, as the name suggests, offshore hedge funds are the funds who are located in low tax countries. For example, Cayman Islands. There we don't have tax, right? Low tax countries, they actually they open the fund in there and they operate from there. So offshore funds are if the investor, the one who is investing, and the fund is into different countries, then that kind of fund is known as offshore hedge funds. And domestic, when the, for example, if a person is in US, if the individual is in US and even the hedge fund is located in US, it's open there. So this is like the taxation and the fund, the both are in the same country. That's domestic hedge funds. Then we have fund of fund. So it's a unique kind of fund. Fund of funds, again, we also have the same concept in private equities, where to minimize our risk we don't invest in a same fund, we just diverse our investments. We invest in various kinds of securities A, B, C, so that our risk could be minimized. And based on that, so fund of funds, they invest in various kinds of stocks and bonds. Okay, individual, not in one thing, but they diversify the investments. So in previously we discussed that taxation structure also differs from various kinds of alternative investment funds. We have three categories, right? 1, 2, and 3. 1 and 2 categories. So hedge funds falls under third category. 1 and 2 categories, private equity falls in 2. So 1 and 2 categories are pass-through entities. So what's the concept of pass-through entity? The returns which are generated by these category 1 and 2 funds, they are passed on to the investor, and the tax is paid by the investor who invest in such kind of funds. Whereas in category 3 funds, the fund itself, hedge funds comes under category 3, right? The fund itself has to pay tax on its annual earnings, and in India the tax rate is around 42.74% if the revenue of the company, if the revenue of the fund is exceeding 5 crore rupees. Okay, and this again is passed on after paying the tax. The return whatever is generated by hedge funds are passed on to the investors, and hence the return is reduced. Again, there's no concept of double taxation. The investors have to just show in the returns that they have invested in the hedge funds and already the tax has been paid. This is a similar concept in US itself. In US also we have a pass-through concept. This concept is very popular. So the partnership and few corporations in US. In US we have two kinds of corporations. One is C corporation and one is S corporation. In the S corporation is also a pass-through kind of entity, pass-through entity. So whatever the returns, whatever the profit is generated by the partnerships and S corporations are passed on to the onto the investors, and then the investors pay tax on such on the returns generated by the funds. Okay, so we understood what are the funds involved, how's everything. We understood alternative investment funds, what are the categories, and we understood how private equity funds, hedge funds comes under those categories. We also understood the concept of investment banking, right? So all these, what's the major decision involved in all these funds? That is the valuation of the business, like where should we invest, how should we invest, in what structure should we invest, which company should we invest, that all these depends on the decisions we take, right? So decision making is a key role here. Based on the indicators, based on the current scenarios, we have to take decisions about how to invest, where would we maximize our returns, because as discussed, capital is limited. We have limited capital, and hence we have to the investment, the main purpose of investment bankers and these funds are to maximize the return of their investors. In the limited capital, how we can provide maximum value to the investors, that's the main thing of private equity and the investment banks, right? So to take the decision, we have few tools which help us to take decision. One of those tool is financial modeling. This is one of the key skill, we can say, which person who is interested to go into finance, this is by default the key tool which he must know, how to use that, how it structures, the different kinds, the types, and what's actually financial modeling. So if you want to explore opportunity in finance, you have to know financial modeling. There's no question like do you know financial modeling? You have to. That's a key tool. Okay, so we'll discuss what the financial modeling is. Okay, so just to give you an idea for understanding financial modeling in ease, financial modeling is a tool. Normally, we prepare this financial modeling in Excel. Okay, you can understand as it as input output. So we have a business, we have a company, we give inputs to the Excel, we give input to the model that these are the revenues, the cost drivers, the structure, the historical, the performance of the company, and then we expect this return, and in turn the model gives us the output. The If we input a data, what will be the decision? If this is the change, how will our decision impact? What if future is uncertain anyways, we cannot say that this will be the correct decision, but we can just plan how would it be. So financial modeling is a process of creating a summary of a company's expenses and earnings in the form of spreadsheet that can be used to calculate the impact of future event or a decision. So financial models cannot predict any outcome with high degree of certainty, because since they are dependent on future transactions, there's obviously a degree of uncertainty involved, right? So we cannot predict that this would be the outcome, a decision would be this is the right decision, and the company would grow, the company would generate the same returns as generated as we have seen in the trends. But we could just have an idea, we will get a direction that if our financial model has expected 10% return, we will have a direction that yeah, this company will generate profit, the return could be 8 or 12. So it's approximately correct, but it will give a direction that yeah, we can invest in the company, it's having a positive cash flow, and we can invest in the we can just, the numbers would be here and there, but we have a directional thing that this is the correct flow. Okay, the company is able to generate the returns, and it's good to invest in the company. So it just gives us an idea. And depending on the inputs should be very important, because depending on the inputs only our outputs will be we'll derive the outputs, right? So okay, so what are the objectives of financial modeling? They help in valuing a business, they help in raising the capital, growing the business, making acquisitions, and they help in mergers and acquisitions. They help in the business selling or divesting the business. For example, if a business wants to give its business, it wants to sell its business, what will the value it expect? Okay, so it also, the financial model also helps us in that. And then budgeting and forecasting. Okay, budgeting and forecasting is like, we give our data, whatever the revenue, cash flows, we give our financials, and then the financial model will say us what we can expect in future based on the market trends, based on the, we can also say that this is the future it holds, this, like we are expecting this to rise this much. Based on our inputs, it will give us the output and idea of how it holds. Okay, so we have various financial modeling tools also. Okay, uh, for example, we have a DCF financial model, discounted cash flow model. In discounted cash flow model, we take the cash flows, we take the years, we take the cash flows, we take the terminal value and give it a percentage that we want our cash flows to be discounted using this percentage. Based on that, it will derive the inputs. It will generate. It will give us how we can expect the future, like what can we expect the valuation of the business. Okay, if we change the input, if we change the percentage, if we change the cash flows, based on that, the output would also be varying. Okay, so normally financial modeling is done using Excel. The most popular way which people use is using the Excel. So one of the key skill would also be advanced Excel if you want to go into the world of finance. And okay, so we cannot just give vague inputs to the financial model, right? It should be structured. It should be correct. It should not be just vague data. It should be like structured. The correct figures. We have to give correct figures to the financial model so that we can derive correct output. Then it's dynamic in the sense, if we change the input, it gives, if suppose in future market conditions changes, we want this thing, it's dynamic. Based on, we can change the inputs, and based on that, it will give us the output. And it uses relations between various variables, several variables. For example, if the growth rate increases, what will be our output? We can just tell that we expect growth in the sales to expect by 5% yearly. Based on that, it will calculate and give us the output. And it will also show forecast. It will contain various scenarios, that if the scenario is this, what will be the outcome? If the scenario is something different, what will be the outcome it would produce? So financial model is a structure. It depends on inputs and outputs. Okay, so for example, where can we use financial model in real world? For example, if suppose your friend says that he have invested 1 lakh rupees in a company, and he is expecting the company to generate 10 lakh rupees in return over the 5 years. So he suggested you to also invest in the company so that your capital could grow. Now you are chartered accountants. We as chartered accountants, we don't listen, we analyze, and then we take decisions, right? In this scenario, we will use a model. We will analyze how is it possible, how 1 lakh could grow in 10 lakhs, that too in 5 years. Okay, for 1 lakh to go in 5 lakh, either the return should increase by 5%. So how will this work? Okay, we have to analyze. We just cannot follow the friend, because a friend is a rich kid. He will invest in the company, but we have to analyze whether that's true. That's the role involved here. Okay, and financial models, as already discussed, they cannot predict the output with with certainty. There is some uncertainty involved. So the crux of financial model is, it should be roughly correct but not precisely wrong. Instead of being totally wrong, it gives us an idea that yeah, this is correct. So instead of if we expected the company to grow, financial model helps us to see whether the company is really growing, whether the company is growing. We cannot, if the financial model says the company will grow, but the company is just going down, the company is uh, going down. So we cannot be roughly wrong, precisely wrong. We have to be just correct that yeah, the company will grow. Okay. So as discussed, we have DCF financial model. We also have three statement models. In three statement models, the financial model uses the balance sheet, the profit and loss and cash flows of the company, and then based on that we prepare a financial model. Okay. And these are normally also used in trend, like to set the budgets for the company, so that the company could expect could work according to the budgets. It will help the company to be operationally efficient by giving the budgets to the company based on the market trends in future. Okay, then we also have merger models. These models are used in mergers and acquisitions. Here this model is different from the previous DCF model, and that because in merger and acquisition two companies are involved. Okay, this the data is not of one company. Here more than one company is involved in mergers and acquisitions, so this model is different from the other two models. So then we also have leveraged buyout model. In leverage buyout, in like this model, there is slight variations because this include growth. In leverage buyout models, we also have growth model and investment model. Okay. So these where this financial modeling is used, it's used in valuing the business, and in setting the trends, and in expecting the budgets. In valuing the business, who does the valuation of the business? How it's the valuation is done by investment bankers. The private equity firms also does the valuation of the business, right? So these are used by them. And okay. I hope the bigger picture is clear to you. So normally this financial modeling, uh, we this is very complex things. The financial model actually uses complex data, because the investments here, the numbers involved in financial models are huge. There are millions and billions of dollars involved in financial model. So we must see that the financial model, the excels, the sheets are correctly linked to each other. For example, if you change the sales data in one Excel, that sale data might be linked to your other sheets as well. If you change one data, that should automatically flow to your other models. You cannot manually type. If you manually type, there is a chance of your whole model becoming incorrect, which in turn would impact your decision, right? So the key thing to remember in financial model is you cannot manually enter the data, you cannot change the formulas. The formulas will be changed, and there is a cell where you can input your figures. You must just input the figures in the model. So normally company who uses financial models, they have their clear procedures and policies. Everyone uses their own financial model, but the ultimate thing is that it helps in decision making, it helps in valuation, it helps in projecting the cash flows, projecting the sales, projecting the output, whatever is involved. For example, financial modeling can also be used by a person, maybe a factory production manager, to see whether he needs to purchase a new machinery or not, whether the machinery, whatever he is purchasing, whether it will generate the enhanced cash flow, whether purchasing the machinery is the correct decision or not. And if yes, if he is purchasing the machinery, we have many options, which machinery, how. So the financial model gives us a various pictures. So we have to ensure that financial model, whatever the inputs we give in financial model, are correct. So various companies use various models, and all the cells are actually logged. Like the formula cells are logged. You cannot edit the cells. You just have to give the input so that it automatically flows to all the other sheets as well, because everything is interconnected in financial model. Okay, so financial modeling, this is a very very huge vast concepts. We have so many, we have so many things. This is a very broad concept. The global finance is very broad concept, but here we have covered the major things, like what the hedge funds are, what are investment, what are alternative funds, and how they actually work. So today, if one wants to go into finance, we have number of opportunities. Um so first, when we enter, we will not directly go into the front desk. We'll start from back desk operations. Okay, we will not directly jump into the front desk. Through our experience, through our understanding, we then go in the hierarchy, and through our experience we'll go into the front roles. So normally, the person who is starting as a fresher, they will normally get the backend operations. They work in backend, and we also have uh, skills which are necessary to work in finance. We also have degrees. We also have FRM, that is financial risk management, because see, to acquire a business, to value a business, we have to understand the risk involved in the business. Because we might think that it's a very narrow concept, but no, it's actually very important to analyze the risk involved in the business, because that itself will say how we can expect the business to grow, and what we can expect the return to be. Okay, so we also have CFA degree. We can also do that to understand all these concepts. So here we have just covered in brief, and we just connected all of them. Okay, so just to go in the link. So now I hope you're able to link all these concepts, like what is investment bank, what are private equities, what's a health, and how all of them are interconnected. So all of them are a part of big global ecosystem, and there are many firms who are involved in these functions. Okay. So you can post whatever doubts, questions you're having in the box, and I would be happy to answer all of them.
Okay, so I have here a couple of questions. So I'll just quickly ask you one by one.
Sure.
So one question here says, I believe it's from one of the newly qualified CA, probably looking at the question. What one mindset shift would you recommend to young professionals aspiring to work in global finance?
Okay, so we CAs normally have that compliance mindset. Like we generally go in auditing, we have that compliance mindset, right? In finance, we have to have uh, that mindset. Like whatever the situation is, however the thing is, how we can evolve, how we can take decisions. We should not just focus on the rules. Like if this is the rule, we have to work like this. It should not be on rule based thing, but it should, you have to use your own analysis, your own decisions, your own thing to generate value. Okay, to take the decisions. So yeah.
Okay. Um, One more. If you had to give any one practical advice to develop the thought process to go into global finance, because the person here who has posted, he has said that he doesn't have the required experience
Mm-hmm.
So he has worked in a mid-sized firm where he didn't have any experience about, say, the global finance.
Got
So if he has to go in, so like how?
Yeah. So, um, see, the degree or that's actually important. That adds value. But more than that, if you don't have required skills, even the degree would be of even see, nowadays company needs skills. So you should have the required skills to go into this field. So the entry level is difficult here. You should have the required skills to jump into this. After the entry, then you have numerous opportunities. You like they are in finance itself. Just after the entry, you have various opportunities. You have explore many of them. So I would say degree is definitely important, but then you should also have required skills to go into this. So various we have so many types, right? We have various things require various skills based on based on our interest we can go there.
Okay. Um, Coming to the next question, that we could see that many of the participants more are exploring the accounting process outsourcing,
Mhm.
APO, which we call. So
Hmm.
how does APO exposure help professionals to evolve from executive roles to strategic decision-making roles?
Can you repeat the question again?
Many of the chartered accountants now are exploring or are ready to work in accounting process outsourcing, that is APO. So, how does APO exposure help professionals to evolve from executive roles to strategic decision-making roles?
Okay, so even to take the decisions, you should actually know the procedures involved in it, right? When you don't know what is the outcome of this decision and how what are the procedures and how what are the things involved in it, then you cannot execute it, right? So for that, you need to know what is the process, what is the role involved, and you can just jump.
Yep. Okay, so could you share an example where numbers looked perfect,
Mm-hmm.
but the decision still had to be negative,
The
like
decision
from your
still
own
have to be
experience? Negative.
the
The
numbers are.
numbers were quite
Mm-hmm.
perfect, but still the decision was not in the favor.
Okay. Uh, so there is a company, for example. Uh, we have prepared financial model. We have entered all the inputs. We actually expected that the whatever this company will actually grow in the future. Okay, this will generate positive sales in the future. For example, it's a company. It's into this field. Uh, in the coming 5-10 years, the growth of the companies were the growth potential was very high, but because of the market conditions and market circumstances, we could see that the company has a downfall. So we can expect that company, since now the sales are, since now it's generating a positive revenue, positive cash flows, we can expect that this company is having a great future, great sales potential. But still, due to market circumstances or market uncertainties, we can see that the company is on the edge of liquidating, because there's just because the future is uncertain. We cannot know how and what could go wrong. Okay, we just need to be correct over that, but again, future is uncertain. We don't know what it carries and what happens. And
Okay. Uh, what are the key financial decisions that can make or break a cross-border deal?
sorry.
What are the key financial decisions
Hmm.
that can make or break a cross-border deal?
Key financial decisions that can make or break the deal. It could be if, for example, it could be our investments. It could be our okay. Okay, so key financial decisions, for example, if you want to take investment decisions, okay, the capital budgeting decisions. Here it could be like in which assets, in which long-term assets you have to invest your fund, and how. Like we also have here one more question.
Why do you think DCF method is really the best method in valuation?
Mm, Normally, in all the mergers and acquisitions, we can find the DCF method, that is the discounted cash flow model, is used. Uh, because see, cash flows are really important for a business. Business runs because of cash flows. The turnaround, the cash flows, the DCF, the cash flows are important in making the decision. I could hear my voice. Yeah. Okay. So this DCF model can also be used with other models, but DCF model is one of the key valuation model. And even if our agenda, our motive to use a model is different, we will use that model according in uh, with that. We will also use DCF model to project what the cash flows could be and what will be our return based on that. So you take numerous number of examples. You in news you'll hear mergers and acquisitions going on and everything, but still you will see that discounted cash flow model is used there, and that's one of the key model, because our decisions, our business, our returns depends on the cash flows. So it's one of the model, main model, and we have to use many of the values use that to predict the valuations, to come to the valuation.
Okay. Coming to the next question, what impact will AI and automation have on global financial analysis and decision making?
Hmm. Previously we used to we see global finance. Okay, we have so many of the numbers involved, we have millions and trillions of dollars involved in it, right? Previously we will have that manual thing. For example, uh, even this financial model has made our life easy. Like we'll just input the data, it will give us output, right? So this has made our life easy, but long back this was not the case. Even now in the current scenario, artificial intelligence is used in majorly in all the deals. It gives we have various softwares, we have various models which are built by the company itself. Normally every company also have their own AI board. Okay, so it say the AI, we just post a question about company specific questions, and they have their own policies and procedures about how to generate the thing, how it answers all our questions. Okay, so it's a major it has actually made our decision making skills very easy. It has it has a very powerful impact on our decision making actually. So yeah.
Okay. Uh, can you share some common red flags in international deals that are visible only to experienced finance professionals? Some common red
Mm,
flags which you would have come across.
mm, okay, red flags in
Red
sorry.
flags which you have come across in
Hmm.
the international deals
Okay.
usually.
While if we want to invest in a company, or if we want to crack a deal, we have so much of thing involved. Okay, we'll go from start to end. We have a very long process involved. First, we'll analyze the company, how the company is, which business is the company working in, because the market also impacts the decisions, right? If the company is working in technology, now it's boosting that we have so numerous, we have ever changing technology, right? So market, the company we are in also impacts our decisions, right? So we'll study the market, the products which the company is selling, how what's the market share and everything. We also study how the management of the company is. For example, if the company is good, the product is uh, the product which the company is selling has so much of growth in the market, customers are willing to buy the product, but still if the and also the numbers, the sales, the figures, everything of the company are good, but we use all this. So what we do in valuation, and we use financial metrics, right? We use the sales, we use the cost, we use financial metrics, but the important thing is we should also consider the non-financial metrics here. Non-financial metrics are like the management of the company, the how the company is placed in the market, because even that plays a key financial role. We can just look at the model, we can just look at the how the company is working, the how are the figures involved and all, but still if we don't have the correct management who is involved in the business, it can just break the deal, because we invest not in we just don't see the financial thing, we also see the non-financial thing, right? So that could be a red flag, that could be a deal breaker there.
Okay. How does professional judgment differ when dealing with global clients versus domestic clients?
So uh, in if we are dealing with domestic clients, we know how the business runs, how what are the regulations, and how we have the idea of how is the business operated and what are the regulations that are involved in. So professional judgment is definitely involved, like in whatever deal we are closing, professional judgment we have to use. The management would say that this is a great, like we are expecting us the sales to grow by 20% in coming future years. The management might say, one more thing is the whoever is the acquirer who is the acquiring the business, he wants to pay less, but who is selling the business, he wants to maximize his wealth, he want more returns, he want more thing. So there is always the conflict between the acquirer and acquiree, they want to pay less, they want to pay more. So we have to come in between, we have to fair value the deal, we have to value the deal in fair manner, so that both the acquirer and acquiree have their own, like it's fair value, right? So uh, coming to the question professional judgment, we have to use my in domestic, global, that's thing, but how it might vary. uh, in global, if we are dealing with global transactions, we don't know, see, we don't know if the client is also involved in some other, if it's performing some other like what if it's using layers to hide their transactions, we don't know, right? So we can just analyze the things which are on paper, we can look the paper, we can look their we can look their uh, the deals, the agreements and everything, and can decide whether the deal is actually, whether it's actually good, whether we can invest in the product. But what if the company is hiding at the back, they are doing some other things, that's difficult actually while we deal in global things, global transactions. That's actually easy in India, because if we are doing domestic, we have the knowledge of the things, we know how it is done, but in global you have to check all these things. So there's we have to analyze, we have to input a professional judgment a little more while dealing in global transactions. Again, the
Okay.
concept remains same in both global and but again we should be skeptical.
Okay. Which global skills today are required for the CAs to actively develop to stay relevant in the international business?
Which skills are required for chartered accountants? Okay, normally we all are well, as chartered accountants, we all are well versed with auditing and accounting skills, right? So that's just we all have that skills. But today in finance, the major skills would be there are many skills. We also maybe we also have that ICI sessions going on in this finance. We also have financial modeling by ICI itself. Even ICI is because even we all know that finance is evolving. We have so much of growth in this sector, and nowadays everyone wants to go, like everyone wants to go into finance. So the demand for finance is more, but the companies offering the roles are very limited. So you should be above par to go into finance. If you're aiming finance, you should definitely be above par, because it's you could see that it's outside the picture you could see it's very good. Like if you are interested into finance, you actually have to work for maybe 12 hours, 16 hours a day. You don't know, right? So it might look fancy, but again, if you're ready to all this, it's a very good opportunity. And skills required, all this, we should have that Power BI, we should have financial modeling skills, we should have advanced Excel skill. Advanced Excel is by hook and crook, you have to have it, there's no other option. Okay, there's like, if you are attending an interview in finance, then the interviewer will definitely expect you to know all these skills, all the advanced learning and financial modeling skills.
Okay. When analyzing the cross-border deals, what are the top three financial factors professionals often underestimate?
While evaluating the cross-border
Cross-border
deal,
deals, what are the top three financial factors which professionals often underestimate?
mm, top three financial factors. Cross-border deals, the major financial factor would be taxation, because if we are we are moving in cross-border transaction, right? Each country has its own taxation laws. Each country operates in its own taxation judiciary, right? So the major skill would be taxation. For example, if the sales are good, everything is good, but still, what if 50 and 60% is going into the taxation, then what's the use of that, right? So that could be one of the major skill. We have to analyze what are the government policies and the government policies and procedures, and whether if we have if we are taking a decision based on something which is actually prohibited, which is not allowed, which have so many regulatory requirements there, then then is whatever we are deciding, whatever we have, why we want to invest in the deal, then that's of no use, right? We have to check what are the regulatory requirements and what are the taxation policies which the country has on its own. So that's the reason nowadays many funds actually are going into tax haven countries, because taxation is one of the major in a major thing in cracking the deals, right? So in being in tax haven countries, they are able to manage their funds, they are able to acquire investors from globally, so that the global investors could invest in their funds, and then there's also no tax provisions applicable.
Okay. What role does currency risk management play in global decision making?
What role does currency?
Currency risk management play
Hmm.
in global decision making?
Yeah. Uh, okay. So currency fluctuations are we don't know, right? When what would happen? What's the future? How? So for example, if we have invested for a if we have invested in a deal maybe for 5 years, our period to invest is just 5 years. Okay, now what if after 5 years we want to exit from the business? For example, private equity, they invest for certain amount of period, the long term investment, right? But what if after 5 years there are huge currency fluctuations, there are the the countries are having their own things, and there are huge currency fluctuations? How would we exit from the deal, right? It becomes difficult for us to exit from the deal if we have uh, so we have to also check this non-financial. Again, it comes under non-financial. We have to also check whether it's easy for us to exit from the deal, whether our funds will be invested in that for a long period of time, and what the future holds. How we have to analyze everything, all the decisions which are available in the market.
How protective strategy of countries becomes a red flag for good investment, like the tariff war,
Hmm, hmm, hmm.
uh, the right now the American Venezuelan incident. So how do you think the protective strategy of countries become a red flag for
Hmm.
good investment?
So talking about, if we take example of India itself, previously it was having huge restrictions that these people could not invest here. We are also having a cap uh, that only we can accept a certain percentage of foreign investments. So that was actually impacting our foreign whatever we get from the foreign. That was impacting our economy. That was impacting our GDP and all. So the government of India have come to the decision to increase the factor, and now we are having a higher limit to accept the foreign investments. So the government again, as said, government policies and regulations play a key role, and the government has to see based on its economy how it can how it can just loosen its things, loosen its regulations, so that the company can attract more investors in it.
Okay. How do global macroeconomic factors like inflation, interest rates, and geopolitics influence the deal structuring?
How the
Global macroeconomic factors like inflation, the geopolitical factors, or the interest rates
Mm.
influence the deal structuring.
Yeah. Again, we have this here. I just remember the concept of arbitrage. So because of that interest rate fluctuations, we invest in one currency where we have to pay less, and we invest in a currency where we will get more. So this is the whatever the gap we get, that's because of arbitrage. Okay, so that's our profit. So I remember this here because interest, all the macroeconomic factors play a major role in decision making. For example, if we are investing in a deal which has low interest rate fluctuations, low interest, and we have two investments. One is low interest rate and other is high interest rate, but the currency is the currency fluctuations are so large. Even if the interest rate is low, we actually have even if the interest rate even if the return we are expecting is high, still the profit we are generating would be low, because of all these macroeconomic factors. So we have macro again, we have to also thinking when the economics perspective, and how the decisions being taken based on that.
One more question here is from the future perspective.
Mm-hmm.
Like, what do you think 5 to 10 years from now? How do you see that the role of CAs will evolve in global finance?
Hmm. Uh, Not 5 to 10 years. Definitely, CAs have a major role playing. They play a major role in finance. But from today, even if you see today, chartered accountants have a they have numerous number of opportunities. They we chartered accountants have many skills. Okay, we have the concept understanding. We know what the concepts hold. We have the calculation, how we calculate the things. We have decision making skills. We have, so we as chartered accountants, we are walking book, right? We have many we have many opportunities, we have many skills, we have many things to explore. So even in coming 5 10 years, this is one of the most evolving and improving, we have so much opportunities in this role. Whatever we have covered in this session was just a brief of it. Again, the single concept which was covered, again it has a whole large picture involved. So if you go deep dive into the concept, it's come on it goes on coming, it goes on coming. So finance is such a huge concept, and a single person is involved in a single thing. Okay, so you must decide in what you're interested in, which field you're interested, and according to that you have to decide, because finance is a whole major ecosystem, in that you have many concepts. So you have to, in 5 10 years, chartered accountants are having so many numerous numbers of opportunities.
Okay. And what do you think? Which sectors globally are likely to see maximum deal activity in coming 2 to 3 years?
Which sectors?
Which sectors globally are likely to see maximum deal activity?
Deal activity, what is the sector where we will be dealing in
Yeah, moreover, in the coming years, we'll see maximum deal activities happening globally.
uh, okay, if we are talking about specific sectors, we could the sectors would be, we have this technology sectors, the companies who are working in IT because of this artificial intelligence, AI innovations. And we also have this concept of electric vehicles. We also have this, um, so we have a few major, these are the major sectors where um, we could work in finance, and we could take a decision based on that.
Okay, and one last question. If you had to like leave a message to our members who aspire to build a career in global finance, so what message you would give them?
Okay. Um, See, as already discussed, demand is huge, and the opportunities, like, first of all, you should be confident enough that you have the required skills enough so that you can go into the finance. Okay. Um, if you're confident enough that you have the required skills, you just need to work upon them, you just need to brush upon them, so that you'll have. And nowadays we have, the opportunities, the companies are not limited. Every company has their own division, every company, because uh, finance actually plays a huge role in every company. So every company has its own division, and there are numerous number of opportunities involved. So just you can enter it in the finance, and then you can explore what are the opportunities involved, and then based on your interest you can just go into it.
Okay. And any value-added course which you would suggest the participants out here?
Mm, Value added course, if talking about the course, it would definitely be the one which we discuss now. We have discussed it in just two ppts, financial modeling, right? But it's a huge concept, right? You can take days and days, months and months in discussing how the financial models are built, what is the input, like how, we have so many models discussed, we have so many things. I We have just discussed in brief like what are they and how they are involved, but this in itself is a very huge concept. So and we also have various things for this. Financial modeling is used in valuations and budgeting. We also have various skills in finance. Communication skill is also very important. See, you could present on the paper that you could say that this is a financial model, why you have to invest in this company. You could present it on the paper, you can document it, that this is the input and this is the output which the financial modeling has given, so that's the reason we have to invest in this company. Now when you don't know how to communicate, how what is like how this financial model has said, why do you think that's important, why do you think that investing in the company is important? So, and if you couldn't explain, you couldn't pitch, you couldn't ask for the deal, then the deal is gone there itself. You should explain, you should be communicative enough for you to present your thoughts to be presented on the paper. And there are two parties involved, right? You have to fight the, you have to see that your company is making the profit. So you could be buy side, you could be your sell side, whichever side you are, you have to see that your the one you are providing services is at the best, is at the profit thing. Okay, so that the deal, so communication is also very important.
Okay. So, thank you very much, ma'am, for such an insightful and thought-provoking session. You beautifully connected the global deals with real-world financial decision making, which is extremely relevant for today's professionals, I believe, because right now we are in a era where we have to learn, unlearn, and relearn. Whatever we have learned, we may have to unlearn a few things. We may have to relearn a few more things. And as you know, keeping ourselves updated and upgraded is really very much essential because each and every dynamic is changing quite quickly. So somewhere, yes, AI in ICI, we already have a wing. We have multiple forums which even ICI is coming up with, wherein we can pave our way into the global finance. And with the Gift City and the GCC, lot of new terms. So somewhere, definitely, the information which you have provided would definitely go with us for a long period of time. The webinar organized by Development of International Trade Services and WTO Directorate of ICI continuously works towards empowering members with global exposure, international trade insights, and overseas professionals. So I really would even like to thank the convener, C. Abhay Chhajer sir, and our deputy convener, C. Sanjeev Kumar Singhal sir, so to continuously keep us updated and upgraded with whatever is happening in the economy. Last but not the least, thank you to you, Vandana ma'am, for sparing your valuable time and really making this session quite insightful. I know there were a lot many questions, but you addressed most of them each and every question. So definitely kudos to you. And thanks to the entire technical support team, Gunjan and all, to really make sure that the entire program is quite seamless. And definitely, I believe any webinar success, it all depends on the audience, how they reciprocate. And I believe the questions are more definitely they were listening to you more effectively. So the questions were equally interesting. So thank you to the wonderful audience. Stay in touch, keep yourselves updated. We have many webinars which are lined up ahead. So I definitely wish you a very happy learning. Thank you so much. Wish you a happy weekend as well. Bye bye. Take care. Thank you so much.
Thank you.